Hi there. In this short revision video, let's take a look at how trade in goods and services between countries can affect economic efficiency in markets. Well, there are four main types of efficiency to think about in A2 economics: allocative, productive, dynamic, and X-inefficiency. Let's consider markets where there is open trade. In other words, there's quite intense competition in different markets for goods and services. What about allocative efficiency? Well, if you have significant and intense competition from lower cost import sources, that's going to cause an increase in market supply coming into a country, drives market prices down, and will help to reduce the size of monopoly or supernormal profits. So in a world of intense trade competition, prices will be closer to marginal cost of production, and therefore there should be some gains in allocative efficiency. And also lower prices will help increase the real incomes of consumers. In a world where trade takes place, we should also see an improvement in productive efficiency, because businesses will be specialising and hopefully selling in larger markets. And this encourages them to exploit increasing returns to scale, otherwise known as economies of scale, bringing down their long-run average cost. So allocative and productive efficiency should be improved by trade, and we call these gains in static efficiency. But there might also be some improvements in dynamic efficiency. Now, dynamic efficiency happens over time and is strongly linked to changing goods and services and the rate of innovation in markets. So open economies that trade heavily may see more innovative businesses who will invest more money in research and development, and will also appreciate the significance and importance of improving the human capital of their workforce to lift productivity. X-inefficiency happens when there's a lack of competition in markets, and this causes costs to drift higher. For example, there may be some managerial slack and an increase in fixed costs such as expense accounts. Well, in very intensively competitive trade markets, that competition provides a discipline on businesses to control their unit costs in order to remain price competitive. So overall, there are good reasons for thinking that high rates of trade competition between countries should help to improve economic efficiency. We could also make a call on what's called the dynamic gains from trade. No diagrams here, but this is basically thinking about how trade improves our lives going forward over time. So dynamic gains from trade tend to make the domestic economy that's exposed to that trade more productive. And some of the gains from liberalisation, in other words, bringing down average import tariffs and removing some non-tariff barriers, would include things like knowledge spillovers. So trade between countries often does lead to the exchange of information and ideas between businesses and the diffusion of knowledge and technologies. We've already mentioned, of course, that trade can stimulate economies of scale, lower costs, and increase competition and innovation. What we tend to find also is that the countries that trade with each other, consumers within that country have a selection of more productive firms and also a wider range of goods. Trade provides access to cheaper and more productive imports, goods and services into a country's supply chain. In other words, we can import the things more cheaply that we can't necessarily produce well ourselves. That's the basic theory of comparative advantage. And trade also generates less rent-seeking monopoly behaviour, and it can also reduce incentives for corruption, particularly amongst governments, which then aids human development. So there are big, significant potential gains from trade in goods and services and investment flows across countries. Trade in most cases should improve economic efficiency.